Hey, it's Mike over at Cross Country Mortgage. It's Monday morning. It's time for your Monday morning mortgage update for the week of January the 13th. I was looking back at some data over the last couple years, and this is the start of my sixth year doing this. And I'm so grateful to all of you that listen and give me feedback and find value in me sharing what's going to happen in the market, in the mortgage market as it relates to real estate. So I always try to give you some insight, data, some tools that you can use when you're buying, selling a house, making that decision for your family on your financial goals, working with clients so that you can have more impactful conversations, make more impactful decisions as you enter into the real estate market. So I always talk about what happened the week before and what is expected to happen this week. So let's talk about last week. Last week, big sell-off on the bond market, 64 basis points, meaning money flowed out of the bond market and mortgage rates went up. And there's a lot of reasons for that, a lot of misunderstood reasons. But let's look at the chart first. I'm a visual kind of guy, and I want to give you some perspective. So each one of these bars are candlesticks. And as I move my cursor, a lot of you know this, but anybody's new out there, this represents one day of trading, each one of these bars. When we see a green bar, money's flowing into the bond market, mortgage rates are getting better. When we see a red bar, money's flowing out of the bond market, and mortgage rates are getting worse. And you can see this changes day by day. So last week on Friday, huge sell-off. That's a big movement in one day. And then we opened the market today, so the live feed, 20 basis points now is actually a little worse. So just on the last 2 days, Friday and Monday morning, we're over 100 basis points sell off on the bond market and mortgage rates are going up. So why is that? Well, a lot of people are telling you, the news outlets, the business news is saying, hey, it's because there was a lot more jobs added to our economy. Those numbers came out Wednesday and Friday, but the one that carries typically the most weight is the BLS jobs survey. It's a government report and it's a survey. It's not data. It's not factual data. It's a phone call to a bunch of people and they say, hey, how's it going? What are you doing? Are you applying for jobs, etc.? There's data that they don't count in this survey and it's not trusted. The bond traders do not believe this number, and it's because the numbers have been so different and so off from private actual data, private jobs reports that actually measure data. And then the BLS will come out with this positive number. And then a few months later, they'll make an adjustment and say, oh, all the stuff we said, it really wasn't that true. And they've done this time and time again over the last couple of years. And so the bond traders that trade in the bond market where mortgage-backed securities are determined, and this is what this shows you, they don't believe these numbers. So even though the jobs numbers came out and added more jobs, which means they strengthen the economy, this isn't what moved the market. What moved the market, what did cause this big sell-off here and continuing today is inflation. Inflation. It's the death of mortgage rates. When inflation is up, mortgage rates sell off, and it's because the return that bond traders get in the bond market is less when inflation is up. The money doesn't go, your dollar doesn't go as far. And so that's why the sell-off happened. Some reports came out last week, consumer sentiment, actual consumers. What do you think about where you're spending your money, future of the economy? And the biggest concern was inflation. And then some private manufacturing numbers came out that showed massive inflation, high, not getting under control, some very concerning numbers. And this is what caused the bond market to sell off. So what are we looking at this week? Let's try to give you some insight, three things. We're looking at inflation. No surprise there. The beige book, I'll tell you what that is, and the retail sales. So we're getting two reports this week on inflation, PPI and CPI. The PPI measures inflation on the manufacturing business side. PPI is inflation on the consumer, how much we pay for things side. Both of those reports are coming out this week. We expect those to be higher. We expect inflation to go up. That's not good for rates. Pure and simple. If for some reason that is below expectations, that could be a positive for rates, but nobody thinks that's going to happen. The beige book. So the beige book comes out on Wednesday, and it's a summary and analysis of our economic conditions in all 12 districts. The United States is broken up into 12 economic districts. All those districts report their numbers to the Fed. Fed makes economic decisions on what they're going to do with the economy. And that beige book is the first beige book of the year because the Fed's meeting in 2 weeks. And that beige book is a really interesting kind of a summary on what these districts are reporting now and what they think is going to happen in their area, Midwest, South, East Coast, what they think their economy is going to do moving into 2025. And this will impact the Fed's decision. What are they going to do with rates? Now, the bond traders don't think the Fed is going to cut rates. They're pricing everything right now as if the Fed's not going to cut rates. Now, that is different than what the Fed indicated in December's meeting, where they said they would cut rates twice. So this Fed meeting in January in a couple weeks is going to be very impactful. Last thing is retail sales. How did the holidays go? How did we buy a lot of stuff? We know all the businesses that are in retail make most of their money during the holidays, and those reports are going to be coming out. Now, there's some indication that these numbers might be weak because credit card charges, those reports that have come out so far showed consumers did not charge as much as the expectations were. Charges are down. So what we don't know is, are they kicking the can down the road doing layaway type charges, or did they just spend less money in the holidays? And that's going to be impactful on what the Fed's going to decide, and also with rates. If we see weak retail sales, then that's positive for mortgage rates because it shows a weakening economy. If those retail sales are at or above expectations, then it's not going to be good for rates. So what are we doing this week? We are locking starting day one on Monday, not playing any games with our clients' mortgage rates. And there's a lot of volatility. So if you got a mortgage, if you're working with a mortgage professional, give them a call and tell them to lock. Don't play with your money. If you need any insight or second opinion or any advice on mortgage, don't hesitate to give me a call. If you have any input on this Monday morning mortgage update, I'd love to hear it. Look for it next week. And then also we're adding something new, a Friday market wrap up with where the rates are to end the week. And that'll be coming out on Friday. We're going to be emailing that and texting it out. So if you want to get on the text list, we'll email that out every Friday morning. Have a great productive week.